Now, from the last session, we looked at this idea of full cost, and we noted that one of the features of a full cost was the increasing level over the years of fixed costs and its effect on break-even levels and the effect on risk, the profit. If you had the volume, your profit was higher, but then if you didn't get the volume, you made big losses, and we saw that with the example of Ryanair. So what we want to do now is to look further at the problem of costing and the particular problem that companies face, and that is to try to work out the cost of a unit that isn't just the variable cost but makes some calculation of the fixed cost. So we're trying to relate the fixed cost to our product or service, and in doing that it will help us take decisions as to what price, whether to carry on with it, whether we could do it in a more economic way. So all these kind of marginal analysis type decisions we can take if we somehow manage to relate our fixed costs to the actual product or service. So that's what we're aiming for. And we will see that it's not easily done, but anyway, let's have a go. So discuss our learning outcome, discuss the usefulness for decision-making purposes of deducing a full cost of a unit of output. Fair enough. Deduce the full cost of a unit in I think estimate would be a better one, better term there. Estimate the full cost of a unit of output. And in a multi-product environment, well, yeah, okay, we'll have a go at that. Discuss the problem of charging full cost of jobs in a multi-product environment, and we'll certainly be doing that. And then finally, explain the role and nature of activity-based costing. That is a particular solution to the problem, but it is not the solution. It is one solution that tries to address how you get a cost in a high fixed cost world. Okay, so these are the uses we mentioned earlier: pricing and output decisions, exercising control. We've not really said much about that, but clearly if we can relate our fixed costs to output, then we've got some idea as to what we can afford by way of fixed costs. Assessing relative efficiency, the use of fixed costs, whether we should perhaps hire the costs in, and so be able to compare it with alternatives in our relevant cost kind of decision making way. And then assessing performance. Clearly, if we're going to be looking at the profit per unit, we'll be able to assess performance. So it has a lot of uses of fixed costs, but if it's just left as one lump that isn't changed, doesn't vary, or isn't related to output, it's going to be more difficult to use the fixed costs in these ways. Sorry, it's just that. We must always remember it's not a cost of the product. We allocate fixed costs to the product, but it isn't directly caused by production. Increasing output by 1 or 2 or marginal number of units, small number of units, doesn't increase our fixed costs. So we've got direct costs. These are the straightforward ones, and we're not going to be saying too much about that, but we're talking about materials and labour that can be easily associated with output, and hence our break-even analysis, our control, our decisions, and so on. Then we've got the indirect costs or overheads. These are the ones, as it says, cannot be measured in relation to output, and these are our fixed costs. So it's just another term for fixed costs, if you like, indirect or overheads. We assume that indirect costs and overheads are essentially fixed costs. This is from a survey. The reference is given here. Survey of factors influencing the choice of product costing systems, and they looked at direct costs and indirect costs in the makeup of various businesses. A survey, quite a small survey of 176, 91 manufacturing and service and retail. Notice that service and retail, as you would expect, has a much higher indirect or fixed cost element than manufacturing businesses, but it obviously varies between businesses. This is an average. If you watch a program on TV like How It's Made, you'll be aware that some products are highly automated and therefore a large element of fixed costs, others much less so. But this is certainly increasing. And another factor to consider is that in the UK is about 10% of GDP, manufacturing, and service industries is something like 65%. So services is really a big part of business, and it's something that's exported and imported like anything else. Insurance, Lloyd's of London, they sell a lot of insurance abroad. So it's a product like any other, and you can see that the fixed element is 51% of the total costs. So we've got this concept of a full cost of a job, and to get some idea of what we are going to call a full cost, the direct costs obviously part of the job cost, and then we have this rather awkward term I've added in the question mark, a fair cost of indirect overhead. So we're dealing with economics, not morality. What is a fair cost? A fair cost is the one that helps you maximize your profits. That's the moral argument, because that's what businesses are supposed to do on behalf of their shareholders. So nevertheless, we use the term fair, and it's kind of economically fair, if you like. And that's just to make the point that we can also call our costs fixed and variable. Variable costs are our direct costs, and our fixed costs are our indirect costs. So a particular cost, indirect, is likely to be a fixed cost, and our direct costs are going to be variable costs. So they're just two terms for essentially the same type of cost. But a direct cost is not going to be a fixed cost, and an indirect cost is not going to be a variable cost. So how are we going to look at our overhead? So I don't want to go into this particular activity. You can read it for yourself in the textbook, but this is the typical way in which a cost is made up. Our full cost is made up. We've got overheads and we've got direct costs. Let's deal with the simple ones first. Direct costs, and this is the cost of a sale made by marine suppliers. So we've got direct labour and direct materials. Labour is the labour used in making the sail. Materials, obviously the canvas or whatever they use. So direct costs are straightforward. Now we come to our overhead problem. So we first of all got to work out what overheads we have. There's salaries, rent rates, that sort of thing. Then we have to work out something called an absorption rate. In other words, we've got to have some basis that we can attached to the product that we can charge out a cost on. Then we've got to apply that overhead rate to the particular job. Actually, you get this in garages. When you own a car, you'll get an invoice, and you'll find, well, they don't do it so much these days, but an hour's labour in a garage is going to cost you, I don't know, £60–70 at least. It's not that the garage mechanic is being paid £70 an hour. Of course he isn't, but he's being paid. That's part of the cost. That's the direct labour cost. But also they're all the overheads of the garage, and they're charged out on a labour hour basis. So they work out all the indirect costs, then they work out all the hours they're going to use up over the year or month or whatever time they choose, and then they work out a rate per hour, and then they charge it out. So if your car job takes an hour, it gets charged at 65 quid, and by that they hope that the amount they charge you is going to cover not only their variable costs but their fixed costs as well. And we saw that you had to do that to get to break even and then get into profit. So two popular bases for charging out your overheads. Here it's on a monthly basis. They've got £20,000 in the next month that they've got to charge out. So they can do it in two ways, either through direct labour hours or through machine hours. And they've got two jobs, job 1 and job 2. Now, with job 1 we assume, well, from the way they've charged out, that job 1 and job 2 take up the same number of labour hours. That's why they're charged the same, both 10,000. If we charge out on machine hour basis, however, it turns out that job 1 takes up 70%, in other words 14,000 of the 20 goes to job 1 and only 6,000 of the 30% goes to job 2. So a very different allocation if we choose machine hours, because job 1 takes up many more machine hours compared to charging out on direct labour hours, where they're more or less equal. So, which is fair? There's no real answer to that question. It's both rationale for both, but you can see in economic terms a very different output. So we did say that fairness ought to be equated with some kind of economic fairness, but we come to a bit of a dead end because we can't really say which is economically fair. Okay, right, we're going to leave it at this point, hanging on this question, and we will see how it is resolved, not resolved, attempts made to cope with this problem in business. We'll see that in the next session.